The American economy has reached an unprecedented level of dependence on financial markets, where the FIRE sector, finance, insurance, real estate, accounts for 20.7% of GDP, twice that of the manufacturing sector. Market capitalization has reached a record 221% of GDP, October 2025, exceeding even the peaks of the dot-com bubble in 2000. The 7 largest companies, Magnificent 7, control 36.6% of the S&P 500 index, the fastest growth in concentration in 60 years. Meanwhile, the shadow banking system has reached $238.8 trillion globally, 49.1% of all financial assets, with nearly 80% of the US private sector financed by non-bank institutions. These structural changes create vulnerabilities reminiscent of the 1929 crash mechanisms, though modern stabilizers, FDIC deposit insurance, Federal Reserve tools, bank stress tests have significantly improved systemic protection. The liquidity crises of 2023 and current signals, yield curve, inversion lasting 25 months, credit spreads compressed to historical minimums, commercial real estate problems, point to systemic risks in a new era of financialization. The American economy has undergone a fundamental transformation over the past 70 years. The FIRE sector increased its share of GDP from 2.8% in 1950 to 20.7% in 2023, becoming the largest single contributor to national income. By comparison, manufacturing declined from 31% of GDP in 1953 to approximately 10% in 2023 to 2024, a decline of 70% over 7 decades. The financial subsector alone, excluding real estate, grew from 4.9% of GDP in 1980 to 7.9% in 2007 on the eve of the financial crisis. Corporate profits tell an even more dramatic story. Financial corporations generated only 10% of total business profits in 1947, but by 2010, that share reached 50% of all non-farm business profits. While some normalization occurred after the 2008 financial crisis, the financial sector continues to capture a disproportionate share of national income. Interestingly, in the fourth quarter of 2024, corporate profits stood at 16.2% of national income compared to an average of 13.9% in 2010 to 2019. But this growth was entirely driven by non-financial sectors: retail, construction, manufacturing, and healthcare. Market capitalization relative to GDP has reached staggering levels. The Buffett indicator showed 221% in October 2025, an absolute historical record. For context, in the late 1800s, this measure stood at roughly 50%, in 1969 at 80%, and at the peak of the dot-com bubble in 2000 at 140 to 150%. The current level is more than twice the long-term median of 80% and is considered significantly overvalued. Households hold $40 trillion in retirement assets, second quarter 2024, which represents 32% of all household financial assets. However, wealth remains extremely concentrated. The wealthiest 10% of Americans own 93% of all stocks, a record high, while the poorest 50% own only 1%. Market capitalization concentration in the hands of a few giant companies has reached levels unknown in modern history. The 7 largest technology companies, Apple, Microsoft, Nvidia, Amazon, Alphabet, Meta, and Tesla, control 36.6% of the S&P 500 market capitalization as of October 2025. This is nearly a tripling from 12.3% in 2015, representing the fastest growth in concentration in 6 decades. The top 10 companies account for 37 to 40% of the index, compared to 19% in 2010, a doubling in 14 years. The distribution within the Magnificent 7 has also changed dramatically. Nvidia added approximately $4.4 trillion in market capitalization since 2015, increasing its share of the group from 0.8% to 22.5%. Meanwhile, Apple's share declined from 26.4% to 17.5%, despite growing in absolute terms. Over the 2015 to 2024 period, the Magnificent 7 achieved cumulative returns of 697.6% compared to 178.3% for the overall S&P 500. Historical perspective makes this even more striking. From 1880 to 2010, the average concentration of the top 10 companies stood at about 24%, with previous peaks around 26% in 1980 and at the peak of the dot-com bubble in 2000. Only in 1900 did concentration reach about 38%. The current level of 40% exceeds all modern records. In the case of the Nasdaq 100, the Magnificent Seven account for nearly 40% of the total index, with the technology sector overall representing about 60%. Passive investing has greatly amplified this concentration. In 2024, 50% of global equity funds and ETFs were passive, up from 19% in 2010. On the American stock market, approximately 60% of assets are managed passively. Research by Apollo Global Management showed that passive flows disproportionately increase prices for the largest companies, reducing demand for small-cap stocks and creating a feedback loop. When stocks are added to an index, their correlation with other index stocks increases. Basket trading by passive funds increases price co-movement, reducing the diversification benefit and increasing systemic risk. The largest financial institutions express serious concern. BlackRock noted that 3 of the 15 most risky days for the S&P 500 in 2024 were days of Nvidia earnings announcements. A single company became a systemic risk event for the entire index. JP Morgan called the speed of concentration growth the fastest since 1950 and warned that market leadership is becoming increasingly unhealthy. Russell Investments found that nearly 70% of the economic profit of the S&P 500 comes from the 10 largest companies. Unlike the dotcom era, current valuations are supported by real earnings and fundamental metrics, but concentration nonetheless creates vulnerability to correction. The non-bank financial system has reached colossal proportions, surpassing the traditional banking sector. According to estimates by the Financial Stability Board, FSB, global assets in non-bank financial intermediation (NBFI) stand at $238.8 trillion as of the end of 2023, 49.1% of total global financial assets. The FSB's narrow measure, which focuses on activities with financial stability risks, reached $70.2 trillion, the highest level ever recorded. The NBFI sector grew by 8.5% in 2023. More than twice as fast as the banking sector, 3.3%. In the United States, nearly 80% of the private sector is financed by the shadow banking system, the highest figure among OECD countries. Bank lending to non-bank financial institutions has grown from 6% of total bank lending in 2010 to 16% in the third quarter of 2024, equaling 120% of bank regulatory capital. This creates credit risk and unforeseen liquidity risk for the banking system. The repo market, a critical artery of short-term financing, has reached $11.9 to $12 trillion in 2024, a growth of nearly 70% since 2014. Most troublingly, $4.6 trillion, 38%, represents bilaterally cleared, non-centrally cleared repo, the least transparent segment. Hedge funds are major cash borrowers seeking leverage, while money market funds serve as major lenders. Growth in 2023 of $1.2 trillion was primarily driven by client activity rather than dealer inventory financing, particularly through hedge fund cash and futures basis trading. Private credit markets are exploding. The private credit market has grown from $1 trillion in 2020 to $1.5 trillion in early 2024 and $3 trillion in early 2025. Forecasts range from $2.6 to $5 trillion by 2029. This growth is driven by bank retreat from leveraged lending after 2008 regulations, the availability of $1.6 trillion of dry powder in private capital, and higher interest rates making floating-rate private credit attractive. Money market funds stand at $7.40 trillion as of October 2025, for the first time crossing $6 trillion in early 2024 and $7 trillion in November 2024. Stablecoins have grown to $227 to $231 billion in early 2025, with Tether, USDT, controlling 60 to 65% of the market with a capitalization of $139 to $155 billion. Stablecoin transfer volume in 2024 reached $27.6 trillion, surpassing the combined volume of Visa and MasterCard. Liquidity vulnerability is embedded in the shadow banking structure. These institutions engage in credit, maturity, and liquidity transformation like traditional banks, but without access to central bank liquidity, deposit insurance, or a lender of last resort. The COVID crisis in March 2020 demonstrated the dynamics of forced selling when repo-financed trading created negative feedback loops. Mark-to-market losses led to margin calls, triggering further liquidations. Even in September 2019, repo rates spiked to 6% for a single day, despite adequate central bank liquidity, demonstrating fragility even in normal conditions. Regulators express serious concerns. The Federal Reserve warns that the shadow banking system lacks access to stable and uninterrupted sources of short-term liquidity, and that greater reliance on the shadow banking system may reduce the Fed's ability to inject liquidity into a weakening economy. The International Monetary Fund calls private credit a rapidly growing asset class that now rivals other major credit markets in size, but opacity complicates their assessment. The Financial Stability Board notes that time and again parts of the non-bank sector have played a central role in amplifying shocks. The 1929 crash was caused by excessive credit leverage through margin trading. By 1928, margin requirements were only 10 to 25% of stock price, allowing investors to borrow 75 to 90% of purchase cost, 5 to 10 times leverage. Total margin loans reached $22.1 billion by October 1929, including $12.77 billion in broker-dealer loans. This represented 10 to 20% of NYSE market capitalization, compared to only 1 to 2% today. Of 1.55 million total accounts, 600,000 were margined. By late August 1929, brokers routinely lent small investors two-thirds of stock value. Investment trusts created pyramidal leverage structures using debt and preferred shares. Goldman Sachs Trading Corporation launched Shenandoah Corporation with 33% preferred stock, then Blue Ridge Corporation with 44% preferred stock, 3 layers of pyramid exponentially multiplying leverage. By 1929, investment trusts had raised $3.4 billion in capital, but of 1,300 created between the mid-1920s and March 1940, only 650 survived, with investors losing $3 billion of the $7 billion invested. Utility holding companies employed similar highly leveraged structures using large amounts of debt and preferred stock to maximize control with minimal capital. The crash mechanism unfolded with dramatic speed. After reaching a peak on September 3, 1929, Dow at 381.17, the market began declining on October 3. By October 23, the market fell from 415 to 384 times index, a 6.3% decline, with margin calls issued overnight. On October 24, Black Thursday, 12,894,650 shares were sold, a record at the time. The market opened lower, the ticker immediately fell behind, there were no buyers. At midday, Thomas Lamont from JP Morgan organized a pool of bankers and Richard Whitney placed a bid at $205 per US steel share, $5 above market, placing an order for $20 million. The Dow fell to a low of 272.3 but recovered to close at 299.5. On October 28th, Black Monday, 9,212,800 shares were sold. The Dow fell 38.33 points, minus 12.82%. Banker support was absent. On October 29th, Black Tuesday, the worst day in stock market history until 1987, 16,410,030 shares. The ticker was 2.5 hours behind. The Dow fell 30.57 points, 11.7% to 230.07. $14 billion in stock value was lost. There were no buyers. By November 13th, the market reached its yearly low, Dow at 198.7, a 50% decline from the peak. On July 8, 1932, the Dow reached bottom at 41.22, an 89% decline from the 1929 peak. The index did not return to September 1929 levels until November 23, 1954. Liquidity dynamics during the crash were brutal. Margin loans contracted by $1 billion in 7 days, October 24th to 30th. Corporations and out-of-town banks recalled loans after Black Thursday. Margin lending completely dried up. Bid-ask spreads increased fourfold during the crash, explaining 1/5 of the dispersion in daily stock returns. The fixed timing of margin calls concentrated selling pressure. Bank failures continued. In 1930, 1,352 banks with $853 million in deposits failed. In 1931, 2,294 banks with nearly $1.7 billion in deposits. In total, about 4,000 banks failed. The modern system has important protective mechanisms. Federal Reserve Regulation T limits borrowing to 50% of initial margin instead of the 10 to 20% of the 1920s. FDIC deposit insurance protects depositors up to $250,000, preventing most bank panics. The Federal Reserve can act as an unlimited lender of last resort. Trading schemes have automatic circuit breakers for large declines. The banking system is consolidated and geographically diversified, not the 29,000-plus small unit banks of the 1920s. SEC comprehensive oversight since 1934 and mandatory corporate disclosure significantly reduced information asymmetry. However, systemic vulnerabilities remain. New forms of credit leverage through derivatives and repo create different but potentially comparable risks. Shadow banking operates in various forms, evading regulations. Moral hazard from too big to fail incentivizes excessive risk-taking. Global interconnectedness creates transmission channels. High-frequency trading and cryptocurrencies introduce new uncertainties. Behavioral patterns of speculation, euphoria, and credit cycles remain unchanged in human nature. The collapse of Silicon Valley Bank on March 10, 2023, was the largest bank run in U.S. history. After announcing on March 8 capital raising of $2.25 billion, following a bond sale of $21 billion with a $1.8 billion loss, customers initiated withdrawals of $42 billion in a single day. The FDIC seized the bank with assets of $210 billion, the 16th largest U.S. bank and second largest bank failure in history after Washington Mutual in 2008. In subsequent days, Signature Bank and First Republic Bank, each with assets over $200 billion, failed, while Credit Suisse became the largest failing globally systemically important bank, GSIB, since 2008. SVB had a concentrated deposit base from the technology sector, with 88% of deposits uninsured, above the $250,000 limit. The bank accumulated unrealized losses on its bond portfolio as the Federal Reserve raised rates throughout 2022 to 2023. The bank held securities as held to maturity, masking fair value losses. Technology accelerated the run. Social media and mobile banking allowed deposits to vanish in days. The USDC stablecoin from Circle also experienced a de-pegging, falling to $0.87, a 13% decline, as $3.3 billion of USDC's $40 billion in reserves were trapped at SVB. The Federal Reserve responded by creating the Bank Term Funding Program, BTFP, on March 12, 2023. The program provided one-year loans, accepting Treasury securities and agency securities at par value, not market value, solving the unrealized losses problem. Peak utilization reached $165 billion in January 2024. The program closed for new lending on March 11, 2024, as scheduled, and all loans were repaid by March 2025. The FDIC and Treasury also took an historic step of protecting depositors in failed banks beyond standard limits. The estimated cost to the FDIC was $20 billion. The yield curve inversion became the longest on record. The 2 to 10-year spread inverted on October 25, 2022 and remained inverted until December 13, 2024, 25 months, surpassing all previous records since the 1960s. The deepest inversion was minus 108 basis points in July 2023, 3.90% versus 4.83%. Historically, yield curve inversion preceded every U.S. recession since 1960 with only one false positive, 1966, typically with a lag of 6 to 18 months. However, by the end of 2024, approximately 2 years after inversion, a recession had not materialized, with the economy growing 2.9%, 2023, and over 3% annualized in the second and third quarters of 2024. Credit spreads are at historically low levels, signaling potential complacency. High-yield bond spreads stand at about 2.8% as of October 2025, near historical minimums and in the bottom quartile decile throughout history. Historically, credit spreads widen before stock market corrections, with widening greater than 300 basis points, 3%, typically signaling approaching correction. October 2025 analyst reports noted the beginning of credit spread widening, particularly in the Eurozone and SOFR swaps. Commercial real estate creates ongoing systemic risk. $2.2 trillion in CRE loan payments are due over the next 3 years, with $929 billion due for repayment in 2024 alone. Regional and community banks hold about 80% of total bank CRE lending in the US, with CRE representing 44% of total lending for regional banks compared to only 12.5% for large banks. Office vacancy rates stand at 12.5%, comparable to 2010 after the global financial crisis, while delinquency rates approach 10.4%, the peak of the 2008 crisis. The Federal Reserve estimates that 282 of 4,000 US banks face challenges related to CRE and interest rates. In October 2025, new stress signals emerged for regional banks. Jefferies Financial Group disclosed $715 million exposure to First Brand's fraud bankruptcy, while Zions Bancorp reported a $50 million write-off on 2 commercial and industrial loans from California Bank and Trust, expecting a $60 million credit loss reserve. The regional bank ETF, KRE, fell 6.3% in a single day on October 16, 2025. Credit card delinquency rates reached the highest level since 2011, auto loan delinquencies the highest since 2010, while mortgage delinquencies have steadily increased since the end of 2021. Despite these alarming signals, positive indicators of resilience exist. In June 2025, all 22 large banks passed Federal Reserve stress tests, though the test was less stringent than 2024, 30% CRE decline versus 40%. Major banks are well capitalized with CET1 ratios above 10% versus a 5% minimum, with JP Morgan Chase showing 15.4% in the first quarter of 2025. The S&P 500 reached its 56th historical maximum in 2025. The volatility index VIX stands at a moderate level around 16 to 17 October 2025, close to the long-term average. However, structural vulnerabilities remain. The BTFP ended in March 2024, removing the emergency backstop. Deposit flight risks from regional banks have not fully normalized. Sustained high rates stress borrowers. Small banks approach minimum capital requirements. Despite improved capital positions, liquidity problems persist. The combination of the longest yield curve inversion in history, record market concentration, squeezed credit spreads, a massive shadow banking system, and ongoing commercial real estate problems creates a multifaceted risk profile that recalls, though in modern form, the structural vulnerabilities that led to the 1929 crash. The American economy has undergone a fundamental transformation from a manufacturing to a financialized model, where the FIRE sector generates twice the GDP of manufacturing, and market capitalization has reached 221% of GDP, a level unknown even at the peak of the dotcom bubble. The concentration of 7 megacorporations in 36.6% of the S&P 500 index, combined with the dominance of passive investing, 50% of global funds, created a system where individual corporate events become systemic risks for the entire market, a phenomenon reminiscent of the role of investment trusts in the 1920s, but at scales that dwarf that era. The shadow banking system at $238.8 trillion globally, half of all financial assets worldwide, finances 80% of the American private sector without the protective mechanisms of traditional banking. The $12 trillion repo market, $3 trillion in private credit, $7.4 trillion money market funds, and over $200 billion in stablecoins create an interconnected network vulnerable to runs and sudden loss of liquidity. Bank lending to non-bank institutions equaling 120% of their regulatory capital transmits systemic risk between regulated and unregulated sectors. The events of March 2023, the largest bank run in history with $42 billion withdrawn in a single day, technologically accelerated by social media and mobile banking, demonstrate new dynamics of liquidity crises. The USDC depegging at 13%, the failures of 3 of the 4 largest bank failures in US history, and the necessity for the emergency BTFP program with peak utilization of $165 billion showed that modern stabilizers, while more effective than 1920s tools, face qualitatively new challenges of speed and interconnectedness. The longest yield curve inversion in history, 25 months, credit spreads at historical minimums of 2.8%, commercial real estate exposure of $2.2 trillion with 44% concentration in regional banks, and the beginning of spread widening in October 2025 create a constellation of warning signals. that the economy avoided recession 2 years after inversion may reflect either successful Fed policy or delayed but inevitable correction. Historical pattern suggests recessions often occur within 6 months of yield curve resolution. The critical difference between 1929 and today lies not in the absence of risks, but in their transformation. Instead of margin lending at 10 to 20% of market capitalization, the modern system has shadow financing that exceeds the official banking sector. Instead of investment trust with pyramidal leverage, we have passive funds concentrating capital in 7 corporations. Instead of 29,000 fragmented uninsured banks, we have a globally interconnected system where a liquidity crisis in Silicon Valley triggers stablecoin depegging. Modern protective mechanisms, FDIC insurance, Fed tools, stress tests, improved resilience against traditional banking panics, but created moral hazard and shifted vulnerabilities to less regulated shadow sectors. The fundamental lesson is that financialization itself is a systemic risk. When an economy generates more value from financial operations than from production, when 93% of stock wealth is concentrated in 10% of the population, when half of global financial assets operate outside regulated banking system, and when 7 corporations can determine the direction of the entire market, the system becomes simultaneously fragile and too interconnected to allow failure. Parallels with 1929 lie not in the exact mechanisms of margin calls or investment trusts, but in structural imbalance between financial superstructure and real economic base, in wealth and power concentration, and in collective illusion that current valuations can persist indefinitely. Modern stabilizers may prevent an exact repeat of 1929, but cannot eliminate fundamental system risks built on financial engineering instead of productive capacity.